Hello and welcome to this episode of Mic'd Up. My name's Pete Seiler. I'm a member of our business development team here at iCM. And for today's episode, I'll be joined by Mike Paciotti, iCM's Chief Investment Officer. Mike, thanks for joining us.
Glad to be here.
So let's jump right in. What are the top areas of the closed-end fund universe that you and your investment team get most excited about over the next 12 to 24 months?
So the first one would be broad closed-end funds in general. In closed-end fund space, there are four dominant drivers of return or risk factors, right? So you have a rates beta, you have a yield beta, a spread beta, and an equity beta. And they aren't all equal. So the rates beta is basically the impact on performance when rates move up or down, just like bonds would be impacted, right? So it's by far and away the most meaningful beta or performance driver in closed-end fund space. Not far behind that, though, is the yield beta, which is always positive and just corresponds to the coupons that you clip and the appreciation of any discount bonds as they move toward par or at maturity. So when you consider that the average yield of a closed-end fund universe is about 8%, that's an investor's starting point for return, meaning if nothing happens, no change in rates, no movement in equities, that's the return that would accrue to an investor who, in equal weight, invested in the entire closed-end fund universe. So, that's pretty good. When you consider that the Fed is likely to cut rates at some point over the next 12 to 24 months, your rates beta is the most influential source of return. At 8% yields plus falling rates and some discount narrowing, it's kind of easy to see how a scenario like this could push returns well into the upper teens.
Wow. So let's continue to drill down on this a little bit. Are there any specific segments of the closed-end fund universe that really stand out?
Yeah, munis are still best of breed, although discounts have come in just a little bit. In September, October last year, the nadir of discounts in muni closed-end fund space was about a 13% discount at the universe level, which represents a 2 3/4 standard deviation event, or about a 0.3 probability. So said differently, they've only been cheaper 0.3% of the time. So that's historic levels of cheapness.
Sure.
Discounts have come in and today are about 10.5, or rather boring by comparison to standard deviation event, or a 2% probability. Still great. But what's even better is to look at the performance that you captured along the way. From October through February, the muni closed-end fund universe has appreciated by roughly 15% as compared to about a 6% gain for the Bloomberg aggregate.
Okay, so given these facts, really, what do we learn from this?
So I think a couple of things. Number one, it illustrates the stacking nature of returns in closed-end fund space, right? You have the normal asset class return on bonds of roughly 6% over the period, closed-end fund alpha from discounts closing, plus incremental yield, and you arrive at an equity like 15% return on a muni bond portfolio. Two, I think the second lesson here is that just a little discount closing goes a long way. And third, with yields north of 5% on muni closed-end funds and discounts north of 10, along with the likelihood that the Fed eventually has to cut rates, and the opportunity is pretty clear. We've only really scratched the surface here.
All right. So for areas of the closed-end fund market that you didn't mention as exciting right now, what do you feel about, or how do you feel opportunities would open there?
So with closed-end funds in general, they're really the embodiment of behavioral finance, right? So if you see herding and momentum, performance chasing elsewhere, it's even more prevalent in closed-end fund space. So this type of retail behavior tends to create narrower discounts or even premiums in popular asset classes and really steep discounts in the unpopular ones. So U.S. equities, which have really been the spot to be for some time now, are the perfect example of this. On the surface, discounts are okay at about 7.5%. But if we eliminate the premium funds, the average discount is pretty solid at about 10%. This includes about 64 of the 79 funds in the universe. Only 5 of those 64s, though, would be fresh buys today. So you have discounts that are okay, probably just not a fat enough pitch to swing at just yet.
So what could cause, or what would cause that to improve enough for you to deploy some of the ample dry powder that we've talked about?
Any event that would sour investors on U.S. equities will likely result in a much broader and more plentiful pond to fish in. So specifically, any kind of a hard landing or perhaps an issue with the banks or commercial real estate where stocks decline, I don't know, 15, 20, 30% would probably flush out a number of good buys for us that would allow us to deploy some of that dry powder that you mentioned.
So, Mike, let's continue here. From your perspective, how would someone get the most out of using our strategies, TICE or Tactical Income Closed End, or TAO, TICE Alpha Opportunities?
So TICE is designed to capture elevated yields and closed-end fund alpha on top of a normal market return, right? So while there's nothing excessively risky about that, TICE was really intended to be a liquid alternatives type of strategy that provides investors with that unique source of return that their current portfolios are missing, right? It's great in a UMA scenario where advisors can carve out a meaningful slice of a portfolio, say anywhere from 20 to 50% of the portfolio, and capture those yields that we spoke of that are about 8% currently, along with those discounts closing, and add that to an already diversified portfolio.
All right. So, drill down a little bit. Why do you say that, or why is that really?
Well, because the single greatest growth engine for investors over the long term is owning an undervalued asset that returns to fair value over a period of years.
All right. So essentially, what you're getting at is this extra step between TICE and TAO.
Yeah, exactly. So TAO is designed to kind of be the complete solution if you want it to be, right? It was our response to advisor partners who asked for that complete solution, right? So 50% of the portfolio in TAO will be invested in a closed-end fund strategy like TICE, while the other 50 is dedicated to the asset classes that are the very best from a valuation standpoint that we could find.
All right. So, a natural question that someone might ask is, aren't they really the same?
No, because we can use the diversity in closed-end funds to take bigger bets on contrarian or undervalued assets than when blending it yourself. So essentially, your best bets probably end up being a bit watered down more than they need to be if you're blending TICE with another strategy on your own. But there are probably some legitimate reasons that an advisor might do that.
How about in cases of embedded cap gains? What's your thought there?
Yeah, so that's kind of what I was thinking about, right? So that's a good use of the UMA structure. You have an existing portfolio. It's got some embedded gains, but you want to diversify your risk by including closed-end funds. Then I think you satellite TICE. Otherwise, I think you're probably better off using TAO. So honestly, when rep will ask us what our best ideas are, they're really in TAO, right? A closed-end fund portfolio mixed with a portfolio of the most undervalued equity and fixed income assets from across the globe that we can find.
Great. Mike, as always, I appreciate you taking time out with us today. And thank you for watching this episode of Mic'd Up with ICM. As always, if you have any questions about today's discussion or topic suggestions for a future episode, please do reach out to us at 888-426-4689 or via email at info@icm-invest.com. Thanks for watching.